Walmart and Target was that they were mismerchandised. They had the things that we've already bought. And so I don't think you have a general consumption problem. And listen, it's getting weaker as much as a shift away from some of the things that we've been spending money on in the past. And that's what you're seeing more than anything else. The second issue at these retailers, and this is something that's interesting, is that margins have held up surprisingly well across the entire S&P 500, but they have not held up well in consumer stocks. So it's not an indication of the health of the consumer, but these businesses, for some reason, are really they're struggling to deliver profits in this environment, which is beyond simply consumer demand.
It's been a massive struggle for that industry. It's been a big struggle at the index level too. As we close out the first half, we're down hard so far this year to date. Your base case, Anastasia, I'm just looking at the growth numbers you're expecting here for the US and the Eurozone, likely to slow to 1.5% year over year by the fourth quarter of 22. And then I look at China, it's even more constructive. You think we can rebound to 5% here? So as we look away from maybe the index, the S&P 500, Anastasia, can you walk me through where you're comfortable taking pockets of risk in this equity market, both on an industry basis and also a regional basis as well, geographically, through the year 22 and into the back half?
Yeah, sure, John. I mean, first of all, we should acknowledge that we're not out of the woods here, and we're at 3,800 on the S&P 500, and I think there is a chance that we still break below that as we go through the second half, and certain things could break, and they could, consumption is going to slow down. So I do assign a probability that we still maybe get to 3,500. Maybe it's a pretty bad recessionary scenario of 3,300. But having said that, think about where we came from. We're at 4,700 on the S&P 500, and that was not a buying point. But we are now much below that. We've almost matched the average recessionary correction or median recessionary correction of 24%. So I would say for long-term investors, we're not trying to time the exact bottom. The risk reward has improved materially if you're looking a year or 2 years out. So with that said, I like some of the cyclical trades right now. For example, financials have been thrown out like a baby with the bathwater, but I actually think if we do engineer a soft landing, that's a place you may want to look at. Energy. I wanted to take profits on energy just a few months ago because I think it's ran a lot in a short period of time. It has pulled back a lot, and if China does in fact rebound, then I do think that this could be very positive for energy prices. And then last is software. Talk about margins. Not interested in retail margins whatsoever, but software margins are quite strong.
A couple of seconds into the opening bell, we're down 1% on the S&P 500. On the Nasdaq, we're down by 1.1. John, I wanted to give you the last word here. Give me your year-end forecast. I know it's constructive, and walk me through why you think it's achievable, given all the risks on the table right now.
Yeah, I mean, listen, I think that we're going to have a double-digit return between now and the end of the year. And I'll tell you what I think drives it. If you look at what we've seen so far this year, profits are up 7.5% year to date, and they'll probably be up another 5 to 6% between now and the end of the year. So we don't have a profit problem as much as people say. What we have is the valuations. The PE multiple is down over 30%, I think 31% on the market. And that's an enormous adjustment, which makes stocks much cheaper. So we think that the earnings continue to move forward, and we think that you get a bounce in valuation, probably a couple of multiple points between now and the end of the year. Stocks will still end the year cheaper than they started, and they'll be up double digits between now and December.
John, can I ask you this? Do you think the Fed will be happy to see that?
Yeah, I talk to people at the Fed. I don't think that they are focused on what the stock market is doing. What do they care about? They care about inflation and jobs. I think, so I really think that they're focused on the mission, and I think Powell may be behind the curve, but he's doing a pretty good job of being clear what his focus is right now. Inflation is too high. They have to address that, and that's where they're going to spend time.
John, the reason I ask that, and forgive me for jumping in, isn't the mechanism to achieve that tighter financial conditions? And one element of tighter financial conditions are wider spreads and a softer equity market.
Yeah, but I mean, when you think about financial conditions, and I know that there's some people who define it, including equities, and some who don't. I'm in the camp that you have to look at very simply. If you wanted to borrow money, is it available to you? Let's take a look at the things that I care. Again, I'm talking about what I pull off my Bloomberg terminal, but the Bloomberg, index for bankruptcies is at record lows. That's not what happens when you're going into recession. That's not what happens when the economy is melting down. That fewer and fewer people are going bankrupt. You would need to see that spike if you're going into recession. If you look at people who are defaulting or businesses defaulting on loans or not making loan payments, we're not seeing that at all. Anastasia was talking about a soft landing, but in many ways, this environment there's this. If you look at the stock market, you feel like it's a recession, and then you look at these metrics on the health of the credit market, and it just doesn't feel recessionary. So, I don't think the Fed is going to obsess on the stock market and blink on that. They will blink if the consumer falls apart. That's a whole different issue. They care about the consumer. They care about jobs. They care about spending.
John, good to catch up, mate. Looking ahead to a more constructive view from Jonathan Golub of the team at Credit Suisse for the second half of this year, to Anastasia Amoroso of iCapital on her mid-year outlook. Thank you very much to the both of you. Getting things open underway to close out the first half. Brutal start to 2022. Gets uglier going into the end of it. We're down by 1.3% as we close out Q2 on the S&P 500. We're down 47 points with some movers. Here's Abby.
John, well, that recession debate really front and center with today's weak start. 4 down days in a row for the S&P 500 this week, down about 3.5%. And as you were mentioning, one of the worst starts for the S&P 500 in several decades. Taking a look at what is moving beneath that brutal surface, we have Apple down, the heavyweight to all of the indexes, down 1.3%. Even with yields in, the tech investors not going for the stock as valuation concerns become less of a concern. Investors are worried. Bank of America down 2.4% with that rally in bonds and yields in. RH, you were just talking about the surprise that investors seem to have around some of these retailers cutting guidance. Well, RH cutting guidance for a second time this year on slowing demand, down 7.5%, and Carnival Corp down 3.6% after sliding 14% yesterday, as Morgan Stanley says that the company could be facing a wipeout. This again against the backdrop of a potential recession and a wipeout in consumer demand. John.
Abby, thank you. It has been brutal for tech stocks, closing in on their worst performance for a first half in 20 years. JP Morgan cutting its earnings forecast on some of the biggest names, running the following. Our biggest estimate reductions come in online advertising and e-commerce. Given the macro pressures, we are increasingly cautious around the impact of a broader economic slowdown, as ad spending is highly correlated with GDP. On the West Coast, let's get to Ed. Morning, Ed.
Yeah, good morning, John. We're down 1.4% on the NASDAQ 100, almost every single name in the red. It's interesting that JP Morgan call kind of undermines the idea that because we've seen such declines, we're in cheap territory. The valuations have come down to a cheap level. Not really the case. We're on track for our worst first half of the year on the NASDAQ 100 since 2002. I wasn't around doing this in 2002, but that's quite a stat to reel off. Look at this chart in the Bloomberg terminal, though, because there is a split on Wall Street. You look at some of the biggest names, mega caps in particular, and there is still bullishness, at least if you look at price targets. And what I think is so interesting is I hear a lot of names, and I believe your last guest mentioned this as well, talking about free cash flow yields and other metrics that are indicators of value, right? We do talk about value buyers potentially coming back in, but we're also questioning if we've seen the bottom yet. The other interesting call, especially with regards to what Powell said yesterday and this idea of whether or not the economy can withstand tighter policies, to look at Amazon. I think Amazon was one of the names that they cut, but they could benefit in this recessionary environment because they offer lower prices, quick delivery. But if the consumer is soft, is that really the case with a name like Amazon? There's a lot of moving parts here. Earnings season, I'm very excited, Jonathan.
I'm sure you are. I'm looking forward to it. It kicks off July 14th with JP Morgan, unofficially anyway. Ed Ludlow, thank you. The retailers have been a pretty poor story. The interesting thing for me about the retailers is that they come out and give you a negative guide, and then a month later, seemingly, they give you another negative guide. Restoration Hardware has been doing just that. They came out, they give you a softer guide, and then they had to come out again yesterday and do it all over again. They said this: the deteriorating macroeconomic environment has resulted in lower than expected demand since our prior forecast, which wasn't that long ago. Our expectation is that demand will continue to slow throughout the year. Kelly Lyons has more. Hi, Kaylee.
Hey, John, well, you hit the nail on the head. It is how quickly things are deteriorating for these retailers that is really remarkable here, because we know Restoration Hardware is not alone. We've seen similar moves from Target, for example, all met with really punishing market action the day after. If you think it's been bad for technology this year, try being a retailer, because that is the group of stocks that is actually underperforming even tech, on pace for the worst year going back all the way to 2008, globally down about 30%. The story here really being that inflation is putting pressure on the consumer. We saw that reflected in the spending data we got out earlier this morning, and that in turn puts pressure on retailers' ability to pass on the higher input costs they are facing and creates margin pressure. And this is really true across the board. No matter what segment of retail you look at, be it the department stores or e-commerce, specialty retailer, even food retailers, which fall more into the staple than discretionary category, all of them are down double digits on the year. And yet it seems, as is the story really broadly with the analyst community these days, they are a lot more optimistic than investors are, because when you look at the gap between 12-month price targets and the actual stock price for the consumer discretionary sector, it's the second widest of any major sector, 28.6%. So clearly the sell side sees some upside as we move into the second half, John.
Kelly Lyons, thank you. I want to keep it on the consumer. David Kostin at Goldman Sachs putting out some brilliant research going into the last weekend, saying the following: declining consumer spending represents a threat to earnings for consumer discretionary stocks and the autos industry group in particular, especially in the case of a recession. David Kostin joins us right now. David, let's start there. The consumer. I want your thoughts on what you're seeing and where you think this is heading.
Well, the consumer balance sheets are in excellent shape. The concern would be on the discretionary spending, given the higher cost of food and energy costs and things like that. So the consumer discretionary stocks heading into the second half of the year, one of the biggest concerns will be the margin pressures that they've experienced. And I see that, you saw that in some of the Target as an example. You mentioned earlier about the inventory problems, some of the guide down, but they also raised their dividends by 20%. So I think the belief on the part of many management teams is that this is a more temporary pressure, and the fundamentals of the business remain, modest. And our preference would be more companies that are more resilient in that, and that's going to probably be in the healthcare sector, consumer staples, where you have less margin vulnerability. That's been the long-term pattern in a downturn or recession, that their resilience in their margins is much more powerful than consumer discretionary, where they typically go down pretty significantly, and that leads to lower earnings, and lower earnings, Jonathan, as you know, typically presage lower share prices.
David, if we ask Jan Hatzius about that consumer balance sheet, the strength of the consumer, I think he'd say the same thing. I'm interested in whether there is a different story away from the headline, away from the aggregate numbers that we talk about consistently on shows like this when we talk about the strength of the consumer. David, do you see a different breakdown when you look at low-income households to high-income households? And does that shape your view on where you want to be in pockets of this stock market?
Oh, yes, we did. I mean, the consumer spending is definitely challenged as you look out into the calendar year and into 2023 in particular. So the lower quintile of the income distribution here in the U.S. is going to see, probably a roughly 9% decline in their discretionary spending ability. And even at the highest end of the quintile, in terms of that broader distribution, is probably flat. And so there's still a lot of challenges and so the headwinds of higher costs around energy and mortgage rates, sort of discretionary spending will be pressured, food costs, a lot of pressures, and that's why focusing more on more business-oriented sort of companies where their end market demand is coming would be a preferable area in terms of positioning a portfolio right now.
I want to talk about the price of the story too, David. These issues, inventories at retailers, the change in spend from goods to services, we've been talking about this for a while. We know it's happening, and yet the companies come out and say it, and we get this massive gap lower in the stock. Why do you think that is, David? Why is a story that's talked about so much so poorly priced still?
Well, it's a good question. Look, that's where the sort of the investable gap is, that the idea of earnings degradation has been pretty slow in terms of the negative revisions. You know, the normal pattern, Jonathan, is you get about a 10% or so cut in estimates in the sort of months ahead of a recession, and then you go into recession and the earnings get cut by another 15%. And so the stock market tends to trade ahead of that. So that's the degradation or the degradation of the profit forecast. Stock market moves a lot faster. So that would be the explanation. That basically the market's going to act first and worry about the adjustment in profit forecasts later, which is why the idea of, you know, where are the companies, what companies have more resiliency? Where have you seen a stable growth? You see Comcast, you see Google or Alphabet, you can see Colgate-Palmolive, you can see of somebody like Amgen, you can think of companies, Johnson & Johnson, which they have demonstrated ability over many years to have stable growth. Not necessarily the fastest growth. In some cases they are and they aren't, depending on the year. But those are the attributes that investors should be looking for in this environment that we're looking at right now. We're about to start the second quarter earnings season, kick off in about 2 weeks, and the expectations right now is about positive 5% year-over-year growth. That includes the energy sector, of course. And if you take out the energy, you're looking at down 3%. This will be the first time we've seen year-over-year declines in earnings. That's if the expectations are realized. Still, that's a negative year-over-year growth. That tends to be a concern. It's one of the reasons why the vulnerability is going to remain in the market for the third and the fourth quarter, where expectations right now are for double-digit growth year-over-year, and that's probably, you know, likely to come down a lot as a result of both the results for the second quarter and then, more importantly, the guidance looking forward, Jonathan.
The stocks are down hard again. We're down 1.6% on the S&P. On the Nasdaq, we're down by 2%. David, before we talk about something out in the next segment, I want to talk about year-end price target in just a moment. Can we finish on this on households? They're getting hammered. Now, David, you did some work going into the weekend about just the household holdings of equities and what you think will happen with them, and it sort of goes against the grain a little bit. David, can you walk me through on what you and the team are looking at?
Well, right now you've seen actually positive inflows into equities in the first quarter, about $75 billion. We've seen that as well, kind of year-to-date, probably closer to $100 billion. So there's a lack of alternatives. I know in the last several years, the TINA acronym, there is no alternative, has meant equities particularly attractive. So obviously prices have come down a lot, and the question is, what are the other alternatives now? There are some. Cash is, by the end of the year, maybe yielding 3%, but bond yields have been negative, been a bear market effectively in bonds and in equities. So still there are some parts of the equity market that are more resilient, and that's an area that's likely to see more inflows. The biggest source of demand is really corporate buybacks. Now, we're in a period of time now where in the blackout period where companies are precluded from repurchasing on a discretionary basis. So stock prices are down a lot. Look at the Goldman Sachs buyback desk, and there's actually extraordinary amounts of repurchases, accelerated stock repurchases that were completed just before, in some cases, the blackout period. And when the earnings season is finished and companies report the results, they're probably likely to move back and repurchase stock. Obviously, buying it down at these levels is obviously much more accretive than it was 20, 30% higher.
David, stay right there. We need to talk about year-end price target in this Federal Reserve. We'll do that in just a moment. David Kostin there at Goldman Sachs with us for at least 5 more minutes. We're down 1.6 on the S&P. On the Nasdaq, we're down 2%. Coming up, central bankers reaffirming their pledge to tame inflation.
Is there a risk that we would go too far? Certainly there's a risk. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
That's next. This is Bloomberg.
We're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
Could he be any clearer? Chairman Powell of the Federal Reserve. Equities down 1.6% on the S&P. On the NASDAQ 100, we're down on the NASDAQ. We're down by about 2%. On a session lower on the quarter. Ugly on the quarter on the S&P 500, down 17%. Lucky to conclude this morning with David Kostin at Goldman Sachs. David, I want to come straight to you on your 3-month price target, which was out about a month ago, so I imagine it's a 2-month price target now, and your longer-term price target, and this idea as to whether the Fed put is now a Fed call, and ultimately they do not want to see an easing of financial conditions and a rally in this equity market. Your thoughts on that, sir?
Absolutely. The view here at Goldman is one of the transmission mechanisms to slow the economy is through tightening financial conditions. And so the first order would be the Fed raising the funds rate, which of course it is doing. But the other components of the financial conditions index would be bond yields, credit spreads, the dollar, equity valuations. Those are other building blocks of a tightening financial conditions environment, or loosening to the other extreme. And to the extent that equity prices or valuations were to rise, that would be orthogonal or at cross purposes with the goal of tightening financial conditions. Therefore, I would put down as sort of 4,000 would be a level, sort of a ceiling over the next several months. It would be difficult for equity prices to kind of pierce that level on the upside, and that would be the idea. If that was to be happening, the Fed might have to be leaning harder into forward guidance and things like that. So our general view here is that the idea of limited or sideways move in the equity market, it's been mostly moving, Jonathan, in the 3,700 to 3,900 range for at least the last month or so. 20% of the trading days this year, the market's moved more than 10%, more than 2% in a day, which is, extremely, it's 2.5 times more levels of volatility than you've seen daily moves over the last, 20 years in terms of the frequency and the magnitude of these big moves. So the idea of looking out towards the end of the year, the sort of baseline scenario would be if the Fed has and inflation starts to recede in the fall, that would allow equity prices perhaps to move higher. Alternative scenario would be recession, and in a recessionary environment, in a scenario, you're probably looking at a level of the market around 3,150, and the sort of transmission mechanism for how that happens would be a series of significant negative earnings revisions across the market, looking into 2023, and that would take a consensus number right now around $250 for next year in profits. That would probably take that down closer to 200, and then that transmission mechanism, as it sort of degrades, we talked about in the previous section, that would probably lead to a multiple that goes a little bit lower. The idea of the equity market having derated from 21 times earnings to around 16 times or so now, 16 times forward earnings, that's been the total driver, the significant driver, higher rates, lower equity prices. We just haven't seen it on the earnings front. So that's the idea that we would lay out as a strategy and the sort of thought process, and we want to inoculate or eliminate some of the downside risk, and that's why that earnings stability is such an important variable, an attribute of companies in this environment. If the economy was growing more rapidly and rates were lower, you might look to lean in towards more growth. That's not the environment we're looking at right now, and that's why the value of those stable companies is to be prized from a fund manager point of view.
And David, this is really important stuff, and I'm still not sure everybody gets it. David Kostin, thank you, sir, of Goldman Sachs. Just on this idea that we've gone from a Fed put to a Fed call. Chairman Powell validated what we've seen in this market. Mike Schumacher of Wells Fargo said earlier this morning, what we've seen is a feature, not a bug, and we're going to see more of it. Chairman Powell said this yesterday. Markets have been pretty well aligned to where we're going. Where we're going next is your trading diary. That's next. This is Bloomberg. Big cracks in credit over the last couple of days. High yield spreads breaking out through 550. That's on the table, getting very, very close to that level. We're down 1.9% on the S&P. On the Nasdaq, we're down 2.4%. An ugly end to an ugly half. We're down more than 21% so far year to date on the S&P 500. That's the price action. Here's your trading diary. President Biden heading back to the United States later today. Tomorrow, the big data point, the ISM manufacturing numbers and monthly auto sales in the United States, plus PMIs out of the Eurozone. And I believe we get headline CPI too. Remember, a long weekend stateside, so Monday, no trading. Markets closed for Independence Day. The FOMC minutes coming up on Wednesday. And finally, of course, looking ahead to next Friday, the payrolls report to round out the week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, June 30th. Here are the top market stories that we're following for you at this hour. Bye-bye the first half of 2022. The S&P suffers its worst half to a year since 1970, while energy and yields soar. Your playbook for the rest of the year. And recession fears mount. Consumer spending slows as prices stay high. Markets start to price in a rate cut by the Fed in 2023. And OPEC's gamble. OPEC Plus will add oil to the market in August, while investors start to question how much more oil the Saudi commodities can get out of the ground and for how long. We're going to speak to Ed Morse, Citi Global Head of Commodities Research. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, in some ways it feels like the market is taking the Fed very seriously. They're going to dampen down any kind of demand, and we're already seeing that in the data, and you're seeing that reflected in bond yields and the equity market.
Yes, equity market's off today. Massive bid in the bond market, which I think is fascinating. I wonder whether that's some of the quarter-end flows, month-end flows making their way through into the system. But nevertheless, there is plenty to think about. We have a decision out of the Supreme Court, the final big one that we are waiting for. It relates to the EPA. Let's get the details. We go now to the Supreme Court and Bloomberg's Emily Wilkins. Emily, what do we know?
So we know that this was a major ruling, and we're still waiting for details on exactly how big it is going to be. We know that this is certainly going to have an impact on what President Biden can do in actually getting his climate agenda done. This is over concerns on whether the EPA can regulate emissions from power plants. And the question is exactly how far the Supreme Court is going to wind up going today. I mean, they could go to the point where this is going to not only impact the EPA, but numerous federal agencies and really put limits on what a president's going to be able to get done.
So Emily, to dig into the reading here, so the Supreme Court is curbing the EPA's climate authority. It says that the EPA cannot seek a shift to cleaner sources of power, and this really goes to the legality of what the Clean Air Act can really do. Does it regulate within your fence and what your emissions are, or can it regulate what kind of energy you have to use? And it appears that this potential decision is weighing against doing anything outside your fence.
And that is really going to limit what the Biden administration is going to be able to do. We've already seen their climate agenda stumble in getting through Congress. It's not clear that Democrats are going to be able to move anything, and certainly not clear they're going to be able to do so after the November elections, which is supposed to be in the favor of Republicans. And so this could make it very, very difficult for Biden to move forward with his climate goals, and it could really impact how the U.S. and to a certain extent how the U.S.'s allies see the U.S. in approaching climate.
Well, let's just talk about that. We were in Glasgow not that long ago. The U.S. was there. It was setting some pretty ambitious targets. Where does the rest of the world now go if the United States cannot follow?
Well, one of the things that President Biden wanted to do when he got into office was to kind of bring the U.S. back as a leader on climate in the world stage. And so you saw him re-engage with the Paris Accords, begin to talk about climate. But if he doesn't have a Congress that's behind him on this, and he no longer has the ability to do some of these major and significant regulations through the EPA, that's really going to limit what the U.S. is able to do. And in which case, allies might look in the U.S. and say, well, if they're not going to commit to sort of some of these higher goals that were planned, why should we follow along with them?
Yeah, and let's put some context here. This is West Virginia versus the EPA. And just for some background, so back in 2009, the Trump administration replaced the Clean Power Plan with one that really weakened what the EPA and what power generators had to do. Now, a group of states sued to block that Trump plan, and that is what this lawsuit is about. They won, and now West Virginia is repealing that lawsuit. So siding with West Virginia, in essence, is allowing the weaker Trump measures to continue forward. This is a 6-3 ruling, and the interpretation far-reaching means that the U.S. Clean Air Act is likely to keep the administration from imposing the type of wide-ranging emissions that the EPA had tried to do. Emily, I think this also begs the question, is this that the Clean Air Act is not the right vehicle for the EPA to impose restrictions? Or does this mean the EPA cannot at all impose restrictions? Because therein lies a very big distinction in the authority of what the EPA can do.
Absolutely. I mean, certainly the EPA was given authority from Congress under this Clean Air Act, under laws that were passed decades ago. What this ruling really questioned, and I actually spoke with West Virginia's Attorney General about this, he said it's not so much about climate for him. It's more about really the separation of the different branches of Congress, that Congress is the one that makes the laws. And so if Congress wants to regulate something, that needs to be from Congress, not from an executive agency like the EPA. So when I spoke with
with him, he really framed this in terms of a sort of whole of government. How does government work? How do Americans get their laws and their regulations? How much is from Congress and how much are from federal agencies? So for him, that's really what this whole entire lawsuit was about.
Emily, just to change tack just a little bit, the president speaking in Madrid a few moments ago at the NATO summit, saying that he backs filibuster changes to restore abortion rights. What's the situation in the Senate? How much authority is he likely to have there in order to make such a change?
Well, certainly it's a huge announcement from President Biden. He's one of sort of the very old school way of looking at things. He wasn't really in support of banning the filibuster or abolishing the filibuster the way that many progressives in his party called for. Of course, exactly what this means, it might not mean too much because it's not just Biden, it's actually senators now who have to agree to overturn the filibuster. And we've seen numerous senators, Senator Joe Manchin, but certainly other senators as well, who've said that they do not want to eliminate the filibuster. They're worried about what it could mean if Republicans take over the Senate, and they want to make sure that that precedent is in place. It's unclear if Biden changing tack on this will change some of the thoughts and opinions. We have already seen Senator Joe Manchin's perspective on this change. He actually voted against a bill that would codify Roe versus Wade in May, but then after the Supreme Court ruling, came out with a statement saying that he would now support such legislation to do so. So we know that they have 50 votes, but they still need to deal with that filibuster. And at this point, it does mean something that the president came out and called for it, but we really have to pay close attention now to what Senator Manchin and other senators want, because it's going to take all 50 of them, all 50 Democratic senators, to agree to actually change that filibuster.
Emily Wilkins of Bloomberg Government outside the Supreme Court. Thank you very much indeed. Let us return to our question of the day. This issue of when the Fed will actually start to cut rates. That is the question that we're trying to figure out. And basically implicit within that is the idea that we are going to have a recession probably in the interim. How deep will that recession be, and will that recession be deep enough to drive inflation out of the system? Bloomberg's international economics and policy correspondent Mike McKee joining us first up to discuss this. From a market perspective, we bring in Kriti Gupta, Bloomberg market correspondent. Mike, let's talk about this. The market is pricing the possibility of 50 basis points of cuts next year. Given the data we're seeing at the moment and the uncertainty that exists, where are we in our understanding of how quick this cycle is going to be, this hiking cycle is going to be, and whether or not the recession will be sufficient to deal with the inflation problem?
Well, the way you phrased the question, Guy, I'm going to point to a quote from Jay Powell yesterday at that Centrist conference where he said, we now know a lot more about what we don't know about inflation. And that's kind of the situation here. We are seeing signs that some inflationary aspects, even on the headline side, are rolling over. Crude oil's been down for a couple of weeks now, and now we see wheat prices falling on this idea that maybe the Russians are going to let some of the Ukrainian wheat out. And so therefore, we might see by next year, inflation come down to a livable level. But if you go back and look at what inflation, and here we are showing on the screen what inflation was like, it had been flat for years, for decades really, and now all of a sudden it jumps up. They want to go back to flat. So they'll keep the pressure on, but they may be able to let it come down a little bit, take some of the the rate rises away, but still keep them off zero.
Well, and Kriti, for the market, this is a huge whipsaw. I mean, literally 3 weeks ago, it was the Fed can get this under control. Then the Fed cannot get this under control. And now the Fed can get it under control again. And you're really seeing that within the markets. What are we pricing right now?
Well, it's interesting because when we talk about recession cuts, we don't really, or I should say rate cuts, we don't really talk about that as even an option, because one of the ideas here is that you want to tackle inflation. And honestly, you maybe want to hit that recession even harder. But basically, if you're looking at the markets, I'm going to do this through euro-dollar spreads, which essentially for our non-bond geek audience is essentially what's pricing in the rate changes or rate expectations in the next 12 months. And right now you're looking at it down by about 53 basis points. In fact, what they're saying that in the next 12 months, you are going to see the Federal Reserve cut rates and actually go lower and lower. And this is significant because it's not saying that this is happening immediately. It's saying that this is happening essentially in the summer of 2023. Whether or not that's right, of course, we know this pricing changes all the time, but at least that's what's slated for now.
Mike, what signal will the Fed be looking for to make the decision that it feels that it can cut rates? Is it that we are seeing the GDP numbers slowing down, i.e. growth slowing down? Is it that they now see their models predicting that we'll get back down to target, they're on a trajectory to target, down to 2%? What I'm wondering is what clue should we be looking for? And I looked at today's PCE number, which did show a slight deceleration in inflation. What should we be looking for to understand how the Fed's reaction function is going to work during this period?
Well, you may just want to create your own model and put a lot of numbers into it, because that's what the Fed's going to be looking at. The PCE inflation core basis did fall a little bit, and I mentioned that we're seeing some inputs drop in price over the last month, but that's got to continue. The market is going to price, as Alex was just saying, they're going to price with a lot of volatility month over month as we see data come in, and the Fed only makes their predictions once a quarter. So there's always going to be something of a disconnect there. But the Fed wants to see the economy slowing down, and not just in any particular area. Manufacturing slowing, consumer spending slowing, and hiring slowing a bit. They don't want a recession where the unemployment rate goes up big, but they do expect unemployment to rise a little bit. If all those things are happening and inflation's going down, then they can take their foot off the gas pedal, or the brake, I guess, is the official pedal that we're using right now. But until they see a broad-based slowdown, they're going to be holding back.
So if that's sort of what the model that we should all be using, which is like throw a dart at a board or something, Kriti, for the investor, what are they doing? What's liquidity like right now? What are flows doing like end of quarter? And this big question hanging over all of us.
Well, this big question has been hanging over all of us for about 6 months now. It's been driving this idea that you need to have this repricing in the market. And it's a repricing that doesn't just go back to the gains that we've seen since 2020. It goes back even further to 2019 even, where you did see that tech acceleration. I will say, though, as far as we're looking at what the end of the quarter is, what the end of even these first half of the year is, a lot of this looks like 1962. Give me a second here. 1962 was, I mean, we weren't all around then, but known for the Cuban Missile Crisis, so it's not necessarily the recession talk, but you also have this kind of Cold War-esque in the background here. And in 1962, you had 9 straight months of decline in the stock market, only for it to get reversed by the end of the Cuban Missile Crisis. So I wonder how much of that pivot point is really the recession talk or the Fed, as opposed to perhaps an end to the war in Ukraine.
All right, guys, thanks a lot. Really appreciate it. Thanks for jumping in there. Bloomberg's Michael McKee and Kriti Gupta. I don't think Guy was even alive in 62. I'm just putting it out there. All right, coming up.
I was just waiting for that.
Coming up, what will future rate hikes mean for the credit market? We're going to get the inside look down with Jonathan Levine, Chief Investment Officer of Bain Capital Credit and co-managing partner of Bain Capital's next. This is Bloomberg.
The Boston Pops Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon, plus Middlesex Fifes and Drums and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
The path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. The bigger mistake to make, let's put it that way, would be to fail to restore price stability.
If we see greater persistence of inflation, that's second-round effects, then we will act more forcefully. As we respond to this shock, we want to have those options on the table.
I don't think that we're going to go back to that environment of low inflation. As the uncertainty will clear on various accounts, we will have to certainly be less gradual.
That was, of course, Fed Chair Jay Powell, Bank of England Governor Andrew Bailey, and ECB President Christine Lagarde speaking at Sintra yesterday, the ECB get-together. They were moderated, of course, by Bloomberg's Francine Lacqua. What a fantastic conversation that was. Where do we go from here is the question. What is our degree of certainty about what the journey is going to look like? Jonathan Levine, Bain Capital Credit CIO and Bain Capital co-managing partner, joins us now here on CES. Jonathan, it's so fantastic to catch up with you. You always have words of wisdom, and you've always told me that I shouldn't predict, I should analyze. How easy is it to analyze right now? How easy is it to get a handle on what is happening? Because to be honest, we were joking before about the 1960s. I probably haven't been this confused in a very, very long time.
So a pleasure to be here. Appreciate your having me on. There's a lot to analyze. And one of the things when you do analysis is to make sure that you have relevant data, consistent data series, and a broad spectrum of things you're looking at. Inflation, as you talked about earlier, it isn't a single thing. It's the sum total of a bunch of other things. And one of the things we're looking at is different components. What is going on in the overall economy? What are we seeing in our portfolio companies?
Yep.
And we're not reacting to a data point. We're looking at data series. And sometimes, you know, people think they have to zig or zag, and sometimes it just makes sense to stand still and watch what's happening. And make sure that if your analysis, if you're confused, one, you don't have to invest in anything until you figure out what you think the right value is, the right direction is. But two, you better build in more margin of safety, and you better understand where your analysis could be wrong and how it could be wrong.
So, Jonathan, how can you do that if we don't have it? You have to have a call on whether or not the biggest risk is inflation or recession in order to do that well.
Well, I'm not sure you have to have a call on those things as compared to making sure that you are buying things that you can own through those things happening, that are well capitalized enough to be able to survive both an economic downturn or inflation. And I realize the obvious comeback to that is, well, then you're going to buy much fewer things, and that's probably true. The second thing is, it's all about valuation. When I look at credit spreads, they're obviously wider than they have been if they are predicting an elevated level of defaults. If we buy credit today, and let's say the cumulative default rate expected is 20% over the next 5 years, and there's only 12% defaults, well, then that was a good purchase because you bought at a good valuation. And therefore, we're trying to have way wider margins than we've ever had before. And where we think that inflation could destroy a company or it can't survive through a recession, those are probably things we're going to take a pass on right now. There's no need to be a hero.
No need to be a hero, but it is an investable market.
I believe it is an investable market.
Where do you see the pockets of opportunity? So many people come on and stand there. They go, you want to buy infrastructure, you want to buy healthcare, you want to buy those safe areas of the market. Is that the only place I should be looking?
No. I think that as you think about it, there's a couple of things. One of part of our investment style, particularly in our privates businesses, is we are investing in companies where we can have an impact, where we can help companies with growth, with cost structures, with strategic moves. So asking yourself, can I still do those things with a given company, particularly in industries that are out of favor? Secondly, it is somewhat about valuation. Am I buying at a level that if I'm not completely right on the 2-year call, but this company is more valuable dispositively in 5 years if we get the earnings right, if we get the strategic direction right, and we don't over-lever it. And then lastly, you see, particularly in credit markets, but you see it in all markets, that in times of high confusion, people overpay for quality. And that in and of itself is risky. That if everybody, flocks to the same asset class, and you're going to wind up, somebody's going to wind up holding the bag when it all trades down. So we really are taking a much more micro, company by company, industry by industry approach, and not being prescriptive that this is uninvestable and everybody should go pile in here.
So, Jonathan, what kind of then distressed cycle do you think that we're going to see? Like, what kind of bankruptcies? How is this different from an 2008 kind of scenario? What do you have to run from? And then where does that create the opportunity?
So I think that the characteristics of the companies that are going to have troubles are a few. One is they're going to be levered to growth of some sort, and they imagine revenue growth but not cost growth, or they imagine some incredible outsized perfect economy. Two, capital structures are overweighted to bank loans. So the last few turns of bank loans are riskier than they have been before. Three, there could be situations that are, for lack of a better word, a little chaotic because documentation isn't as good as it used to be. And therefore, you want to make sure you fully understand where you are in the capital structure, who the other constituents are, and don't just assume, well, I'm in the bank loan, and that's just like a bank loan was in 2008. And then lastly, I think there's going to be a real focus on real businesses that have a reason to exist, that you would want to be associated with 3 years from now and 5 years from now, and not just 9 months, oh, this is just a blip. It's a good company with a bad capital structure that'll clean itself up immediately. I think you have to have the mindset of being in it for the long run.
Are you already seeing the opportunities starting to emerge? The big question in public markets right now is we've seen the valuation change, so we've seen that leg of the market downturn. Now do we get the earnings recession start to really kind of come through? Are you seeing that in the companies that you're looking at, in the companies that you're managing, and the companies that you're analyzing? Are you already starting to see the effects of higher rates, potentially slowing growth, already starting to have an impact? Where are we in the cycle at the moment?
So the maturity wall is actually quite low. And given that, large syndicated companies largely do not have covenants, they have some runway. The people who are going to get in trouble and are getting in trouble now are companies or business models that have gone for growth that rely on access to the capital markets in the future. Right. Or even worse, access to capital markets at high valuations. And we are starting to have conversations with some firms preemptively almost, where they're thinking about, okay, we have these companies that may be running out of money. Yep. We don't want to put equity in. How would you approach them? So they're going to try to avoid the default.
Sorry, just to jump in. Does that mean that there is the opportunity when other options dry up that maybe actually private capital can come in? Just talk me through how quickly that can happen in some of these scenarios.
And this is a relatively new area, but there's a lot of tech firms that have no debt that are, have done the A round, the B round, the C round, and they're not designed to either be cash flow positive yet, and never anticipated having to do down rounds. There's real enterprise value, there's real technology, there may be real customer bases in some of these, and therefore for the first time they may look at some private capital at the top of the capital stack to get them through the crisis, to get them through this time of uncertainty until they can have traditional access to capital markets. We did this once or twice during the 90 days that the markets were off on COVID. But we think that this is an area where a lot of growth firms, growth equity, are going to be looking to find non-equity sources of capital. And then secondly, there are people who embarked on big CapEx plans, real businesses, thoughtfully done, where the costs of what they're building are just way, way, way out of whack. And they're going to have to find different sources of capital to help pay for those projects.
Always interesting to get the analysis. Jonathan, such a pleasure to see you. Thanks for stopping by to see us here in London. Next time you're here, please do the same thing again.
Pleasure. Thank you.
Jonathan Lavine, Bain Capital Credit CIO. Interesting analysis. Coming up, US consumer spending cools, inflation remaining elevated. We're going to get more on exactly what was in today's inflation data. Omar Sharif, founder and president of Inflation Insights, is going to be joining us next to break those numbers down and give us a clue as to how that reaction function over the Fed is going to be working with this data as they plug it in. That's next. This is Bloomberg.
All right, we're an hour into U.S. trading session. It looks like it's going to be an ugly session here. We're down almost a full 2 percentage points for the S&P. Abigail Doolittle is tracking some of those moves for us. Abigail?
Yeah, a bit of a brutal day, Alex. A brutal end to a brutal first half of 2022. In fact, right now the S&P 500 down 21.4% on the year, and it is at 3,748, as you can see, below 3764.90. It is the worst first half going back to 1962. Above that level, it'll be the first worst half since, I believe, 1974. So either way, we're looking at the worst first half for the S&P 500 in decades as investors simply sell off stocks. That's true, too, for the Russell 2000, worst first half ever. The SOX and the All-World Index down sharply. So it's interesting because this is a much worse first half than 2020. Who knew? But that's where we're at right now, at least. As for some of the worst sectors, not surprisingly, it has to do with some of the mega cap tech names. If we take a look at the sectors on the year, massive declines, down about 30% for the likes of tech, telecom, and discretionary. Think Apple, Twitter, Amazon, Facebook, Microsoft. They're all in these indexes, the big index heavyweights. As for one of the concerns, inflation. If we take a look at what's going on for inflation, there is some hope that maybe inflation has peaked. Here we have a number of different measures of inflation, including PCE, the PCE deflator, and then the 5-year break-even, a look ahead at inflation. And you can see that all are sharply higher, but coming off the peak. Let's see whether or not that trend continues. That could have something to do with our next board, which of course has to do with the potential recession that everybody's talking about, because the S&P 500, of course, a forecasting tool looking out, suggesting that the recession economists are talking about could be happening. These are two truly economically sensitive sectors, the industrial metals and the auto and commodity sector. You can see both down sharply on the year, suggesting that investors, Guy, think that yes, the recession that folks are talking about could be ahead.
Yeah, but how deep will it be, and will it be enough to get the inflation that we're also concerned about out of the system? That's the question that we don't know the answer to. The 70s were a series of inflation waves. Are we ultimately going to go back in that direction? Because that wasn't a good place to be. So let's talk about the data today. Clearly a firm focus on the core PCE number of inflation-adjusted consumer spending in the United States. The data we got earlier, well, it was down in May. That's the first time that has happened this year. We are seeing persistently high inflation, and that clearly is feeding through into household budgets. So is this mild dip going to be enough really to change direction over at the Fed? Omer Sharif, founder and president of Inflation Insights, joins us now. Omer, your reaction to the data? It was a little off expectations, but not by much.
No, I mean, quite honestly, I think for the most part, it was very much in line, especially the inflation numbers. But is it enough to change course for the Fed? I highly doubt it at this point. You've got, slowdown in core inflation in the PCE, but core CPI still remains incredibly high. And Chair Powell has said this is not really a time for nuanced readings of inflation. They want to see it going one way, which is lower. And, just having the core PCE sort of standing out at 4% annualized right now, I don't think that's going to be enough to get the Fed to change course in terms of their rate hikes for the balance of this year.
Omer, can we dig a little deeper and get nerdy here on where do we see prices cool, and is that cooling sustainable? And where do we see an increase in prices, and is that increase sustainable?
Yeah, so we're starting to see, some moderation, and as I know you've reported on sort of some of the inventory overhang in items like furniture and household furnishings, that's starting to bite a little bit in the inflation numbers. So more recently, in both the CPI and the PCE, we started to see a pretty marked step down. That's a series that had been growing at almost 1% per month over the last year. It's gone down to close to flat now last month. So there's an area where you're seeing some cooling. Used cars are, at least in the PC data, you're starting to see some moderation there as well. And I think in the CPI next month and going forward, we should start to see that cool as well. So in some of these good sectors, we are seeing some cooling occurring, and I think you'll start to see that in airfares, luckily, over the summer as well.
Omer, what people care about now is gas and groceries. The core is great, and yes, over the long term, it probably is the place to look in terms of understanding deeper inflation trends. But right now, it's headline inflation that the average consumer is having a problem with. Is the core the right place, therefore, to look in terms of understanding the direction of policy?
Yeah, no, I think that's a great point. And you're right, it should actually be the headline. I think Chair Powell sort of made this pivot a couple of press conferences ago, actually, when he started his press conference by basically saying that he wanted to speak directly to the American people. He said that the Fed understood the hardships that inflation was causing. And you can't understand the hardships without knowing what gas and food are doing. And so the headline rate in terms of CPI is about 8.6%, which, by the way, I think next month is going to go up to about 8.8. And on the PC side, it's still well over 6%. So if you're looking at those measures and you're the Fed, it's great that the core PC is slowed down to 4, but the headline is still unacceptably high. And I think that's another reason, given the Fed's pivot, their focus on expectations, that you'll continue to see them ratchet ahead with 75 bips in July and likely a couple of 50s before closing out the year, getting us into that kind of 325 to 350 range by year end.
Omer, what kind of demand destruction can we expect in that scenario that you're painting?
Yeah, I mean, we've only just begun to see some of it in, of course, in the housing market. More recently, yesterday in the EIA's data, you saw that we're running around 600,000 below sort of the norm in terms of gasoline consumption right now. I don't know if that's actually demand destruction, but certainly seems like high prices are starting to put a bit of a cap on gasoline demand as well. But I think for a lot of these items that, household durables, some items, larger goods that require financing, including, autos, you're going to start to see some of those numbers come down. We're starting to see it in used car sales as well. So I think these areas where, rates obviously bite, those areas are already starting to cool, and I expect you'll see more moderation as the year goes on.
Omer, the question I'm trying to understand at the moment is how deep does a recession need to be in order to drive the inflation that we are being plagued with right now out of the system? What are your thoughts on that?
Yeah, honestly, I don't know that we would necessarily need to, induce a recession to get some of this inflation number, some of these inflation figures lower. I mean, in some respects, they are going to be headed lower partly because we are seeing